Welcome to Online Trading Campus and welcome to our unique OTC Futures course. Let's start with our Module 2, Beginner. Before we dive into the first lesson of Module 2, let me give you a brief overview what topics we are going to discuss in this module. Lesson 1, Various Margins Trading Futures. A proper understanding of all different margins existing in the futures market is crucial for trading futures professionally. In this lesson, we will explore the concept of margin and leverage. Lesson 2, Ticks and Points. Also, correct understanding of tick and point value for each instrument is crucial for trading futures professionally. In this lesson, I will explain this key terminology based on various case studies. Lesson 3, Contract Symbols. How to get a future symbol for a chart. Future symbols consist of three components and are used to identify the particular instrument, the contract month and the contract year. I will show you how to use the right symbol for your specific requirements. For instance, you will learn that you require a different symbol for charting purposes versus placing a trade on the same instrument. Lesson 4, Rollover. As a futures trader, we have to understand when and how to move a position from one contract to another liquid contract further in the future. Futures contracts have a limited life cycle that will affect the result of your futures trades and exit strategy. The central terms for that are expiration and rollover. In this lesson, we will focus on the central terms and apply the learnings in the live market environment. I will explain and showcase how to roll over futures contracts to switch from a contract that is close to expiration to another contract in a further out month. Lesson 5, Life Cycle Characteristics. Futures contracts are an obligation between buyers to take delivery and sellers to deliver of the underlying asset. Therefore, any contract must settle and also expire. In this lesson, I will introduce you to the most important date for futures traders, the first notice date. On that date, you put on notice that the expiration is nearing. You must trade to close out of the expiring contract or offset the position. I will also highlight specific life cycle characteristics of widely traded futures markets. Lesson 5, Futures Contract Cheat Sheet. When you trade the complex world of futures, you have to be very mindful. Knowing all specific symbols, contract months, tick and point values from the top of your head can be overwhelming in the beginning. We make life easy for you by providing a futures contract cheat sheet that has all the critical data for all instruments on one single sheet. In this lesson, I will explain how to incorporate this handy guide in your daily trading routine. So let's jump right away into lesson 1, Various Margins Trading Futures. Let's start this lesson by showing you how margin generally works, summarize the key terminology and look into the specific margin requirements using TradeStation as a broker. Last but not least, we have to discuss a specific type of margin that only exists in the futures market, which is called day trader margin. Many traders are drawn to futures because of leverage. Leverage allows traders to commit a small amount of capital to control a large asset. This means that smaller changes in the underlying price can translate into larger gains or losses. In futures trading, this leverage is made possible by trading on margin. Margin is the amount of funds required to enter a futures position, which is usually a fraction of the contract's total value. Margin for futures is different than margin for stocks. In stocks, you borrow against your assets like a loan. In futures, you put down a good faith deposit called the initial margin requirement. It's important to note that gains or losses on futures positions could exceed the initial margin requirement. Understanding margin is essential for a futures trader. So let's look at an example. Let's say trader A is bullish on the S&P 500 and decides to take a long position on the E-mini S&P 500 index futures. Symbol root would be ES. For this example, we'll say ES is trading at 2,800 points, which is a notional value of 140,000 US dollars. Notional value is the cash equivalent value to owning the underlying asset or the contract's total value. In other words, if you wanted to buy a portfolio that reflected the S&P 500 with the same value as an ES contract, you would have to invest $140,000. However, by using a futures contract, a trader can put down a fraction of the contract's $140,000 notional value. Margin is set by the futures exchange and it's typically 3 to 12% of the contract's notional value. Some brokers may choose a higher requirement, therefore initial margin can change anytime. Let's say, for example, the initial margin requirement is $5,500 trading the S&P 500 in the futures market. There are two margins trader A needs to be aware of when trading futures. In addition to initial margin, there's also maintenance margin. Maintenance margin is lower than initial margin. Typically, the initial margin requirement will be 110% of the maintenance margin requirement. When traders first enter a futures position, they need to put up the initial margin requirement. However, after establishing the position, traders are held to the maintenance margin requirement. For this example, trader A has an initial margin of $5,500. His maintenance margin is $5,000 and his account balance is also $5,500. The cash for the initial margin is automatically set aside in his account once the order is entered. By the way, this is a big difference as opposed to Forex trading. In Forex, you can set as many orders as you want, regardless of your account balance. In futures, you are limited to the amount you have in your brokerage account. Once the initial margin exceeds your account balance, you cannot place orders anymore. This is something you have to be aware of. So trader A's buy order is routed to the exchange and is connected with trader B's sell order. Trader B is bearish on the S&P 500 and shorts DES contract. Trader B also puts up the initial margin of $5,500 because the buyer and the seller put up the same initial margin. Let's check the numbers for trader B. He also has an initial margin requirement of $5,500 and is held to the maintenance margin of $5,000, the same as trader A. For this example, we'll say his account balance is also $5,500. The next day, the S&P 500 fell 5 points. Let's see how this affects our traders. Each point on the ES is equal to $50. So with the S&P 500 falling 5 points, trader A loses $250 while trader B gains $250. To understand what this does to each trader's balance, let's discuss settlement. At the end of each trading day, futures trades are settled or what's called marked to market. This is where the daily gains or losses are credited or subtracted from the account. Traders who experience a loss will incur a cash debit to their account and traders who experience a profit will receive a cash credit. Because trader A lost $250, his account was debited, reducing his account balance to $5,250. Trader B profited $250 and was credited to profits, so his account balance grew from $5,500 to $5,750. The next day, the S&P 500 continued to slide and lost another 10 points, or $500. Because trader A lost another $500 after settlement, his account fell to $4,750, which is below the maintenance margin of $5,000. Because trader A's account balance is below the maintenance margin requirement, he's issued a margin call. In order for trader A to stay in the trade, he must bring his account balance back up to the initial margin requirement of $5,500. This could include depositing more money, closing the position, or having the existing position appreciate. Trader B is pretty happy with his trade so far. He just gained another $500, raising his account balance to $6,250. The next day, the S&P 500 rallied 20 points. Trader A's account increased by $1,000 and is now at $5,750. his account balance is back above the maintenance margin requirement, which means he has satisfied his margin call. Remember, if his position didn't appreciate in value, he would have been required to add funds or close his position. Trader B's account balance went from $6,250 to $5,250. To end our example, let's say that both traders closed their trades before expiration. Let's see how each trader fared. Trader A's account started at $5,500 and ended with $5,750 for a return of 4.5%. Trader B started with $5,500 and ended with $5,250 for a loss of 4.5%. You can see how quickly profits and losses on a futures trade can change with just small moves in the underlying index. Remember, gains or losses on futures position may exceed the initial margin requirement, but now that you have seen how margin works, you can better anticipate potential outcomes and plan accordingly. We will obviously do some practical application in the TradeStation account later on. This was just to illustrate the difference between initial margin and maintenance margin. Okay, let's summarize now this part by quickly going through the key terminology again. Notional value. To understand notional value, you first have to know the contract unit. The contract unit is a standardized size unique to each futures contract and can be based on volume, weight, or a financial measurement depending on the contract and the underlying product or market. For example, a single COMEX gold contract unit, which symbol root is GC, is 100 troy ounces, which is measured by weight. A NYMEX WTI crude oil contract unit, which symbol root is CL, is 1,000 barrels of oil measured by volume. The contract notional value, also known as contract value, is the financial expression of the contract unit and the current futures contract price. How to determine the notional value? Assume a gold futures contract is trading at a price of $1,600 per ounce. The notional value of the contract is calculated by multiplying the contract unit by the futures price. Contract unit times contract price equals notional value. 100 troy ounces times $1,600 equals $160,000, which is the notional value. Okay, very simple. Margin is a security deposit, which is the cash deposit from trader to their broker. Initial margin is the maximum margin per contract to open a position. And maintenance margin, the maintenance margin is the minimum margin, the minimum amount, so to say, that must always be met when holding a position. Leverage. This is something that should be clear by now. Leverage is the lending of capital for the purpose of maximizing profits. You move a large amount with a smaller margin. Mark to market. Futures contracts follow a practice known as mark to market. At the end of each trading day, the exchange sets a settlement price based on the day's closing price range for each contract. Each trading account is credited or debited based on that day's profits or losses and checked to ensure that the trading account maintains the appropriate margin for all open positions. Your position in the market is secured by a performance bond. A performance bond is an amount of money that must be deposited with your broker to open or maintain a position in a futures account. The practice of marking accounts to market helps ensure that your account maintains sufficient capital to meet margin requirements on a daily basis. Margin call. If you add to a position or sustain a loss and your account no longer meets the performance requirements, you will receive a margin or performance bond call from your broker. The margin call will require that you either add money to the account or reduce your positions until the minimum performance bond requirements are satisfied. Brokerage firms may suspend trading privileges or close accounts that are unable to meet their minimum performance bond requirements. Mark to market is an important safety measure that provides additional protection for you and your brokerage firm. Combined with other financial safeguards, mark to market is a major benefit of doing business on a regulated exchange. Let me now quickly show you where you can find the different margins for each market. As I told you, the margins can change. Generally, they are set by the exchanges, however, the broker can increase the margin as well. They usually do it once a market acts erratic or is impacted by heavy news and gets therefore more volatile than usual. Bottom line, margin changes and therefore you should always double check before placing an order. To illustrate this, look at that screenshot. The screenshot is from the TradeStation margin requirement website. The site that I told you to bookmark, because you will need this particular site quite often. This screenshot dates back to July 2018. The initial margin for the S&P 500 is $5,500 at this time, and the maintenance margin is $5,000, and for the Nasdaq, the initial margin is only $4,290, and the maintenance margin only $3,900 on TradeStation. Now, let's go to the website. TradeStation.com, pricing, futures margin requirement. This is the one to bookmark, please. Now compare the margins today versus 1.5 years ago. In 2018, on the S&P, the initial margin was $5,500. Today, beginning of 2020, it is $7,260, and therefore, obviously, also the maintenance margin increases. Same on Nasdaq. The initial margin basically doubled from $4,290 in 2018 to $8,250 in 2020. And therefore again, we also see a higher maintenance margin. A reason for the increase, of course, you should be aware of this by now, is the notional value. The US stock indices significantly increased in value, therefore the margin increases automatically because the margin is usually 3 to 12% of the notional value. So to cut a long story short, on that website you find the margin requirement for each product. Initial margin, maintenance margin, and something called day trading rate. The day trading rate or day trading margin I will explain now. As you can see here, it says on the S&P 500 that the day trading rate is 25% of initial. So which means if you hold your position only for one day and not overnight, the broker only blocks 25% from $5,500, which is in this example only $1,375 from your trading account. So to open a position during the day, the exact timings that defines a day I will cover in a minute, you only require $1,375 on the S&P 500. Taking into account that this screenshot is from 2018. Today, the day trading rate is only 12.5% of the initial. So why does this day trading margin exist? Well, simply to support day trading, which results in more trading activity by the trader. Consequently, the broker makes more money on commission. In addition, you have a lower margin, which means as a day trader you can trade way more contracts, which also results in more commission for the broker. Let's make one example here. Let's imagine you went long in the 60-minute demand zone on the S&P 500. You went long at 1,886 points and your stop loss you placed at 1,880 points. So in total 6 points risk. The point value on the S&P 500, as we have learned, is $50. So 6 times 50 equals $300 of risk. Now, if you open that trade during the time window from 6 p.m. to 4:15 p.m. Eastern time, then the day trading margin kicks in. Consequently, the broker will only block the day trading margin from your account. So now let's assume you also close this trade during that time window. Then the only amount of money you require in your futures trading account is basically to cover the $1,375 day trading rate. And ideally your dollar risk, not to jeopardize a margin call. As you see, price came into your demand zone at 10 a.m. and hit target at 4 p.m. So the trade took place during this specific time window. So in other words, your day trader margin was applicable. You closed this trade at 1,935 points, which results in a 49 points profit. 49 points times $50 point value equals $2,450 profit on this trade. By the way, position size calculation we cover later on in this course. So now, I don't want you to focus on day trading obviously. We don't necessarily support day trading, as you already know. We support weekly, monthly and yearly income. So let's assume, just for the sake of the example, you would have kept this trade overnight, meaning beyond this time window for another day. Then your maintenance margin would have kicked in, and from then you require, in this example back in 2018, $5,000 per contract in your account. Otherwise, if you only have enough money in your account to cover the day trading rate, then you obviously get a margin call and the broker will liquidate your position. So let's assume you had enough money in your account and you would have kept this trade overnight, maybe for a couple of days, and took profits at 1,987 points. Then your profit would have resulted in 101 points times $50 point value equals $5,050 profits per contract. So to summarize that part, you have three different types of day trading margins. The one for the Eurex markets I have not stated here because I doubt that anybody will trade the DAX and futures as a day trader. So the day trader margin time window from 6 p.m. to 4:15 p.m. Eastern time is applicable for US equity indices, crude oil, 10-year treasury note, 30-year treasury bond, gold and silver. And the day trader margin time window from 8 a.m. to 4:15 p.m. Eastern time is applicable for other selected futures market. All the markets where the day trader margin is applicable you find on the TradeStation margin requirement site. Also important note here, this can be also changed by the broker, so always double check once in a while if any changes occurred to the current status quo. In the next lesson, we will dive deeper into the various market specifications and look into the different tick and point values and how to calculate them. So stay tuned for lesson 2.